What's up, guys? Thanks for checking into the video. Today's topic is how do I get the best interest rate? So I thought it's a question that comes up a lot. Totally thought we should address it. And I'm sure a lot of you guys wonder, I'm shopping all around town, I'm getting different quotes, so where do I get the best rate? Let's dive right into that. If you are looking for that information, hang tight. You might want to grab some paper and pen. I'll give you a lot of good information, and let me go through all the bullet points of what actually causes you to get the best interest rate. And if you have any questions, just put them in the comments below. One thing that I do ask is if you enjoy the video, please give it a big thumbs up, subscribe to the channel, because it does help the Google algorithm recognize that these videos are relevant to what you're trying to get out of them. All right, so let's dive right in. How do I get the best rate on my loan, whether it's a purchase or a refinance? It doesn't really matter. First thing that we have to address is that everyone's gonna have a different credit score, okay? And the higher the credit score, the better the pricing. I'm a wholesale mortgage broker, meaning that I work with multiple lenders on a lender platform. Wholesale meaning that I actually get the rate directly, the market rate, and I can pass it on to the borrower with or without a rebate. And I'll go into that, in just a little bit. So let's focus on this for a minute. Your credit score determines how good or bad of a rate you will actually get. The better the credit score, the less pricing hits there are against the actual rate that's associated to your transaction. So that's something very important. When somebody calls me up and goes, hey, what's the best rate I can get? I have no idea, I didn't pull your credit. So that's the first question. Moving on to another item that will highly affect the rate is your loan to the value of the property, okay? Because think about this. In terms of risk, if you are gonna give somebody money and you know that the property, is an example, let's pretend you're the lender, is worth $1 million and you're giving them $500,000. They have $500,000 secured as equity inside this transaction. It's extremely unlikely that this borrower is not going to pay their mortgage. They have too much at stake. Therefore, your position is secured. And because it's secured and secured so well, you are likely going to give this borrower a much more attractive interest rate than if the property is worth $1 million and they're requesting $900,000 and they only have $100,000 in this property. Now your position is not as secure as it was when they only had a $500,000 mortgage. Therefore, you're going to compensate for the difference in risk by increasing the rate. Does that make sense? Hopefully it does. Moving on, the type of property. You might have a single family residence and you might have a condominium or a townhouse or a fourplex, duplex, any one of those things. So typically speaking, the single family residence tends to price out much better than the condo, up until about 75%, meaning that you got to put in at least 25% down for the condo to price in close to what the single family residence does. So if you're gonna put down less than 25%, the pricing on single family residence is always gonna be much better, meaning that the rate that you're going to get on a property, a single family residence, is always gonna be better than if it was a condo at a higher loan to value, meaning that there's less than 25% down or equity in the deal. All right, let's get to another point, the type of loan that you are applying for. So as an example, if you are applying for an agency loan, it's also called a conforming loan, and it's the first bucket of loans, meaning that you have conforming high balance in high cost areas like Los Angeles, which is where I'm at. And then you have jumbo. In some areas you do not have that middle bucket, which is high balance. It's strictly conforming. So depending on what type of a loan you're applying for, the associated rate is going to be either higher or lower. So typically speaking, at the lower bucket of simply conforming, not high balance, these loans price out approximately 0.25% better. And then when you go into the jumbo market, they may or may not price out better than agency loans. So 3 different buckets are gonna offer you 3 different pricing options. And just so you know, both the conforming and the high balance loans are both sold on the secondary market, meaning that, well, all loans are sold on the secondary market, but they're sold to Fannie and Freddie Mac. Those are the buyers. They're government backed, meaning that no matter where you get those loans throughout the United States, the guidelines are the same. I'm not saying the rates are the same, but the guidelines are the same. Therefore, these 2 buckets are going to be very similar, as opposed to the jumbo, which is more of a portfolio product. It may or may not be sold, meaning that a lot of these lenders, what they do, I'm just going to give you a little bit of a backdrop so you understand. They have a line of credit, similar to you as a homeowner who might have a home equity line of credit. They let you borrow money on that credit line, and then, assuming they checked all the boxes, they are now able to sell that loan to Fannie and Freddie Mac in the secondary market. Okay, that's conforming and high balance. Therefore, it goes off of their balance sheet and they get that money right back, available to lend to the next person. So that's kind of a little bit how that process works. Let's move on. It depends in which area your property is located. When we price out a property for a quote, we typically put in the zip code, and the zip code will tell you if this area might price out better or worse than another area. Now, something else to keep in mind, which is also very, very important when it comes down to pricing, it's probably the number one thing that's going to affect your pricing, and that's the occupancy. All right. So, as an example, if you're owner occupied in the property, you live there, it's your primary residence, that's gonna price out a whole lot better than if you're buying an investment property. Okay, an investment property likely is not gonna price out anything like an owner occupied. However, if this is a refinance, as an example, and you have a cash out component, add another layer of cost in addition to the rate that you can get. So basically, anytime there is an overlay of risk, there's gonna be an add-on to the rate. So to answer the initial question, what is the best interest rate I could possibly get? As you can see, there's multiple factors that can determine that. It could be your credit, it could be the loan to value, it could be the type of property, it could be the location of the property, it could be the occupancy of the property, and it could be the type of a program that you're getting. So hopefully you got a lot of value out of this video. Hopefully it addressed the reason why you might be getting one rate over here and a different one from over there. And I'm actually gonna go one step further. This is gonna be going really deep into the type of program that would really determine the kind of interest rate that you're gonna get. So you might really wanna take notes for this one. There is 2 types of loans, even when we have all the boxes checked off. There's 2 ways to do the transaction. There's a borrower paid and a lender paid. Now you might be thinking to yourself, this is a bit of a no-brainer. Why in the world would I want it to be borrower paid when I could have it be lender paid? And what is even the difference between the 2? Well, check this out. When I give you a rate that is lender paid, my origination, which is my profit, is already included in that rate that I gave you. Does that make sense? Because the lender pays the mortgage broker or the lender to generate the loan. And this doesn't matter if it doesn't matter if I'm an independent mortgage broker or if I'm a direct lender. There is something called a yield spread premium, a rebate built into the rate that you receive. However, as the lender, as the mortgage broker, if I request to have that removed from the rate, my compensation, the rate drops. That's called borrower paid. So now, any credit that's going to go to this loan, you might be thinking, what credit would go into the loan? Well, remember, you have options when you're getting rates. I don't dictate to you what rate you will receive. You get a waterfall of rates, and with each rate, there's either break even, which is called par, or there is a cost if you're above market, a cost if you're below market, or a credit if you're above market. Okay, so say this is the perfect market, and you receive a rate that's above the market. There's going to be a credit associated with this rate because you picked a rate that's above the market. Whatever credit is associated with this rate goes to you as the borrower. If you say this is not good enough, I want a rate below the market, there's a cost. It's called discount points. That cost is again paid by you. So for taking this type of a loan, the loan officer, the mortgage broker, is going to charge you whatever their compensation is, typically or close to what they receive from the lender if they gave you a lender paid loan, because they extracted their compensation so you can get a much lower rate. Hopefully that makes sense. This is another way for you to get the absolute best rate. If you enjoyed the video, as always, please give it a big thumbs up, subscribe to my channel if you haven't done so already, and I will catch you guys on the next video. Thank you for watching.